You wake up, you go to work, you get paid. The number looks the same as last year, maybe even slightly higher, but something feels off. Groceries cost more, rent costs more, insurance costs more. The same weekend out costs more. You didn't sign up for a new subscription, you didn't approve a new tax, no one sent you a bill. And yet, every year, a small slice of your paycheck disappears, not because of taxes, because of something quieter, something built into the system. It doesn't show up on your payslip, it doesn't arrive in the mail, it doesn't ask permission, but it takes a cut anyway. Let's talk about the invisible fee eating your paycheck, and why almost nobody explains it clearly. Right now, this matters more than it has in decades. In 2020, governments across the US, UK, and Canada responded to a global shutdown by doing something extraordinary. They spent trillions. In the United States, federal spending jumped by over $4 trillion in a single year. The UK rolled out massive furlough schemes. Canada launched large-scale income supports. To pay for it, governments borrowed heavily, and central banks stepped in. The Federal Reserve, the Bank of England, the Bank of Canada, they cut interest rates close to zero, and they created new money electronically to buy government bonds and other assets. In the US alone, the Federal Reserve's balance sheet expanded from around $4 trillion in early 2020 to nearly $9 trillion by 2022. That's not a small change, that's a doubling. Now here's the key question. When more money enters the system, what happens to the value of each dollar, pound, or Canadian dollar? If you print more tickets to a concert, but the venue doesn't get bigger, each ticket becomes less special. Money works the same way. When there's more money chasing the same goods and services, prices tend to rise. We call it inflation. But inflation sounds abstract, technical, academic. So let's translate it into something real. In June 2022, U.S. inflation hit 9.1% year over year, the highest in 4 decades. The UK saw inflation peak above 11% in late 2022. Canada crossed 8% in 2022 as well. That means if you earned $60,000 a year and prices rose 8%, your paycheck effectively lost $4,800 in purchasing power in just 1 year, unless your salary increased by the same amount. Most people did not get 8% raises. Many got 3%, maybe 4%. That gap, that's the invisible fee. It's not charged directly, it's taken through higher prices. You don't feel it all at once. You feel it in fragments. A few dollars more at the gas station, a few dollars more at the supermarket, a higher renewal on your car insurance, a rent increase letter that uses the word market adjustment. Individually, each increase seems manageable. Collectively, they quietly rewrite your standard of living. Now here's where it gets uncomfortable. Governments benefit from inflation. If a government owes $1 trillion in debt and inflation rises, the real value of that debt shrinks over time. It's still $1 trillion in nominal terms, but each dollar is worth slightly less. Debt becomes easier to carry. Wages, however, don't always adjust immediately, especially in salaried roles or in industries with weak bargaining power. So, while debt burdens soften, households absorb the shock. This is not a conspiracy, it's a structural feature of modern monetary systems. Central banks target inflation deliberately. In the US, the Federal Reserve aims for around 2% inflation per year. The Bank of England and Bank of Canada have similar targets. 2% sounds harmless, but compound it. At 2% inflation, prices double roughly every 35 years. That means if you're 25 today, by the time you're 60, the cost of living is expected to be about twice as high. Your paycheck must keep up for decades just to stand still. Now, here's the irony. Inflation is often described as a healthy economy. Moderate inflation encourages spending and investment. It prevents deflation, which can stall growth. But from the perspective of a household budget, even moderate inflation functions like a slow leak. No alarms, no headlines, just erosion. And the erosion isn't evenly distributed. Asset owners often benefit first when money supply expands. Why? Because newly created money typically flows into financial markets and banking systems before it spreads through the broader economy. When central banks buy bonds, that pushes up bond prices. Low interest rates push investors into stocks and real estate seeking higher returns. After 2020, stock markets surged, home prices surged. In many U.S. cities, home prices rose over 30% in 2 years. The UK and Canada saw similar housing booms. If you owned assets, your net worth likely increased. If you were trying to buy your first home, the bar moved higher fast. So the invisible fee doesn't just shrink purchasing power, it widens gaps. Those who hold assets may outpace inflation. Those who rely solely on wages often chase it. Now, let's break down the mechanism step by step in plain language. Step 1. Government spends more than it collects in taxes. Step 2. It issues bonds to borrow the difference. Step 3. Investors, including central banks, buy those bonds. When central banks buy large amounts of bonds with newly created digital money, liquidity increases in the financial system. Banks have more reserves, investors have more cash. Lower interest rates make borrowing cheaper. Mortgages, business loans, corporate debt all become more attractive. Spending increases, investment increases, but supply doesn't always expand at the same speed, especially when supply chains are strained, or energy markets are tight, or housing construction lags. Too much money, not enough goods. Prices rise. Once prices start rising quickly, expectations shift. Businesses raise prices anticipating higher costs. Workers demand higher wages anticipating higher prices. Inflation becomes self-reinforcing. Then central banks step in again, this time to cool things down. Interest rates rise. In 2022 and 2023, the Federal Reserve raised its benchmark rate at the fastest pace in decades. The Bank of England and Bank of Canada followed. Higher rates slow borrowing, slow housing, slow hiring. Inflation eventually cools, but the price level rarely returns to where it was. It stabilizes at a higher plateau. That higher plateau becomes the new normal, and your paycheck has to climb to match it. Now here's the part most people overlook. Even when inflation falls from 8% to 3%, prices are still rising, just more slowly. There is no refund. The invisible fee compounds. Over the past century, the US dollar has lost over 95% of its purchasing power. A dollar in 1913, when the Federal Reserve was created, bought far more than a dollar today. That doesn't mean society collapsed. Economies grew, living standards improved, technology advanced. But it does mean that cash sitting still is quietly taxed by time. This is why people feel pressure to invest, to own assets, to make their money work. Because money that doesn't grow tends to shrink in real terms. And yet, here's another irony. The same system that erodes purchasing power also requires stability. Central banks walk a tightrope. Too little inflation can trigger deflationary spirals. Too much inflation destabilizes economies and political systems. We've seen what high inflation can do historically. In extreme cases, think Weimar Germany or more recently Zimbabwe, extreme money creation led to currency collapse. Those are outliers, not current reality in the US, UK, and Canada, but they are cautionary tales about what happens when trust in money erodes. Trust is everything in a monetary system. Money works because we collectively believe it will hold value tomorrow. The invisible fee becomes dangerous when that belief weakens. Right now, inflation has cooled from its 2022 peaks in North America and the UK. Central banks have tightened policy. Price growth has slowed. But public awareness has shifted. People notice grocery bills more. They compare rent renewals more. They talk about cost of living more than they did 5 years ago. Because once you see the invisible fee, you can't unsee it. It changes how you interpret the news. A $1 trillion spending bill doesn't just sound like abstract policy. It raises a question. Where will that money come from? Higher taxes? More borrowing? More monetary expansion? Each path has consequences, and the consequences often circle back to purchasing power. Now zoom out. Modern economies are built on managed inflation. Not zero, not runaway, managed. The invisible fee is not an accident. It is a feature of a system designed to encourage spending, investment, and debt sustainability. But features have trade-offs.
For governments, moderate inflation can ease debt burdens. For corporations, it can allow gradual price increases. For individuals on fixed incomes, it can feel like a steady squeeze. And the squeeze is subtle. No dramatic crash, no official announcement, just the quiet math of compounding. If your salary grows 3% a year and inflation averages 3%, you're running in place. If inflation averages 4% and your salary grows 3%, you're drifting backward. Not in 1 year, but over 10. That's the invisible fee. It doesn't shout, it accumulates. And here's the unresolved tension. Central banks say they can manage it, and historically they often have. Inflation in advanced economies has been relatively stable for decades, before the recent spike. But global debt levels today are historically high. Government debt to GDP ratios in the US and UK sit at levels not seen since World War II. Canada's federal debt expanded significantly after 2020. Servicing that debt becomes harder when interest rates rise, which creates pressure. Pressure to keep rates lower, pressure to allow slightly higher inflation, pressure to balance growth and stability.
So the question isn't whether inflation exists. It always does. The question is how much of your future purchasing power will be traded to keep the broader system functioning. You won't receive an invoice, you won't sign a contract, but every year your paycheck negotiates with the value of money itself. And the negotiation never stops. So the next time you notice prices creeping higher while your income inches forward, ask yourself, is this just the market moving? Or is it the quiet cost of living inside a system that survives by slowly rewriting what your money can buy?